Thank you very much, everybody. Let me formally welcome you to the series of Sussman and Associates seminars, webinars, sorry. This one is the second capital market webinar that we are doing. We want to start with a few ground rules for all our participants. You will all be muted, but you can use the chat box and the Q&A features to send any messages either to all or to any panelists or to those of us in the administration at the background. You can also use the chat box to contribute to the discussions and ask questions. We have already received several questions from you. Please do not ask any personal questions not related to the subject being discussed. There will be two panels session. The first panel will deal with the equities side of the market. The second panel will deal with issues beyond equities. Our panelists are all here. I would like to express our appreciation to our panelists for your agreeing to participate in this important webinar. Let me start by introducing the panelists. The first panel is going to be moderated by Mr. Deji Ali, who is the founder of ARM and the current CEO of Mixter Africa. The panelists in the first panel are Mr. Graham Heffer, the MD CEO of Okomu Palm Oil Palm PLC. Mr. Haruna Jallo Waziri, the MD CEO of CSCS. The Chief Executive of Stanbic IBTC Capital, Mr. Funsho Akere, and the Executive Commissioner of SEC, Executive Commissioner Operations, Mr. Temidayo Obiso. Then, last but not least, the Group CEO, Emerging Africa Capital Group, Mrs. Toyin Sani. That's the first panel, led by Mr. Funsho Akere, who I've already introduced, the CEO of Stanbic IBTC Capital. The panelists there are Mr. Temidayo Obisan, the Executive Commissioner Operations of SEC, the Chairman Premium Pensions, Alhaji Ibrahim Babayo, the Managing Partner and Co-Founder of Virot Capital, Mr. Eric Idiahi, the MD CEO of Jais Bank, Mr. Hassan Usman, and the lead partner, Metropolitan Law Firm, Ms. Hani Ahmed Usman. My name is Shamsuddin Usman. I will say I'm Q&A session. So without much ado, since we have all been properly introduced, let me hand over to Mr. Deji Ali, who will start the first panel. Deji, over to you.
Well, thank you very much, Dr. Usman. It's a pleasure to be here. I think it's fair to say that after almost 2 decades of extreme market difficulty, the timing for today's kind of engagement is well overdue. And today we will not necessarily be looking at things from a post-COVID-19 perspective, because the issues that the stock market has to contend with go beyond the temporary speed bumps that COVID and other similar challenges have put in the way of the capital markets. And I think it's important to note also that those issues have not necessarily disappeared because of the welcome resurgence that we've seen in the stock market in the last 2 to 3 weeks in Nigeria. I think many of us that are close to the market will also agree that investors have had a very difficult experience in recent years. In fact, when you look at the performance of the Nigerian stock market over a 5, 10, 15, or 20-year period, the return in investment data are strikingly alarming. Cumulative investment over 5 years is under 5%. Cumulative over 10 years is about 48%. Over 15 years, 39%. So it's only when you go to 20 years that you see something which is more decent at about 370% or so. But in dollar terms, most of these returns have been negative. I guess what surprises someone like me, first, about the performance of our market, and second, the depth and evolution of the market, is that there appears to be a contradiction when one takes account of, some of the opposite forces that have acted against the market. I mean, some things to note. As recent as 1994, 1995, stocks hardly traded on the NSE, and daily volumes were insignificant. And that's because investors generally held stocks for life and hardly ever sold. Indeed, my recollection is that it could take anywhere between 3 to 4 weeks to fully invest an amount as little as 20 million naira in stocks of your choice. Settlement failures were rampant. And back then, even a company that described itself as an asset manager not only confused itself, it also confused its intending clients. And that's because the asset management industry did not exist. But I think today, many of these things have changed, and for the most part, have changed for the better. The market is more efficient. The quality of investment ideas has gone through the roof. There's potentially a larger pool of capital to underpin the demand side, thanks to the Pension Reform Act. And on several metrics, stocks are the cheapest they've been in decades. Yet the market has remained in the doldrums despite attractive valuations, and we're frequently told that there is little or no demand for equities. So there's something clearly wrong here. Why is supply, that is listing of companies, been so slow? If supply is low, why is demand not strong? Why is valuation so low when supply is comparatively small? And why is demand weak when valuation is low? And even the dividend yield on some stocks is greater than what you have for fixed income securities. So fortunately, we have with us today experts that have been introduced and will provide answers that hopefully will engage all of us and things we will learn from. And so my first question today will go to Funsho of Stanbic IBTC. you come from the fold of the largest asset manager in the country. So I'll direct my first question to you, and I would like Graham to follow up. Tony to follow up and maybe provide our own perspective to this same question. And the question here for you, Funsho, is with the PFA universe investing just about 10% or a little bit more of assets under management in equities, what in your view is responsible for the apathy? And what could encourage our local fund managers to allocate more funds to this asset class? Funsho, over to you.
Yeah, thank you, Mr. Ali, and good afternoon, everyone. I think I will probably summarize my response in 3 points. The first is really risk versus return. I mean, equities as an asset class has underperformed in the last decade. You spoke a bit about the returns in your intro. I think it's probably done 4 years of positive returns in the last decade, while fixed income has outperformed with risk-free fixed income instruments offering interest rates as high as 15 to 18%. So if you're a local institutional investors, why would you invest in equities in a low growth environment when you could get 15% in risk-free instruments and achieve 2 times money in 5 years? So I think that's an important point to note. Now, you mentioned this is changing with interest rates at their lowest levels in history, or what I would call Black Friday levels. So I think going forward, you should see hopefully an increased allocation to equities. The second is really around the limited supply of quality companies to invest. And this puts fund managers in a position where they come up to concentration constraints. We've seen a dearth of quality public offerings and listings in the past decade, as opposed to what we saw in the 2003 to 2008 era, where you had many companies approaching the market to raise capital. I guarantee you that if we see, or if we have more public offerings of quality companies in critical sectors of the economy, we're likely to see again an increased allocation to equities. My last point is really around corporate governance. And I think that this can be fixed by shareholder activism. I think local institutional investors need to work together to increase the level of shareholder activism and corporate governance in listed companies. They should be in a position to come together to fire CEOs and boards that are underperforming. This hopefully would increase or improve the corporate governance framework and restore some level of investor confidence to equities. I'll stop there.
Thank you very much, Funsho. Some interesting points. I hope we'll have the opportunity to come back to some of the things that you've just mentioned there. But can I go over to Tony to see what your perspective on this question is?
Thank you. Good afternoon, everyone. And thank you very much to Susan and Associates for the opportunity to be here. Deji, I want to say that I align with the points made by Funsho, and I would just add that the regulatory environment in which our PFAs are operating has also encouraged them to be largely risk averse. So when they were set up, and until quite recently, the regulatory global limit for PFA's exposure, for example, to federal government bonds was as high as 80%, and to ordinary shares as low as 25%. And in practice, what we found was that the PFAs broadly invested just about 5% of their portfolios over the last 5 years in equities. Now, they were also set up in a way in which there was no portability at the initial stage, no portability of RSAs. And so there was not a strong base to be aggressive or to be competitive amongst themselves, because essentially once you had the RSA members at the beginning, they were largely captive. And the last thing I will say is that there was also not much room for discriminatory portfolio allocations, in the sense that there was one single portfolio until recently where younger people were now allowed to opt for the Fund 1, which is the more aggressive type that has room for equities. Up till now, not much has been done by way of taking up that opportunity. So I think there is an opportunity for us in the capital market to create awareness about the fact that RSA, the younger people 49 years and below, can now opt for a more aggressive portfolio, which they need to have for their pensions to be available when they're actually going to need them in the next 20, 30, 40 years. Remember that inflation is at 14.25% thereabout now. So we do need those assets values to be preserved over time, and equities gives a better opportunity to do this than others. Thank you.
All right, thank you, Tony. I think you seem to be saying there that regulatory prescriptions have influenced asset managers' asset allocation decisions, and as such, there's been a move away from equities. Okay, thank you very much. I think what I would like to do now is to move over to the other side to look at the issues on the supply side. And my question in this regard will be directed at Fola and Graham. It's essentially this. When you look at things from the supply side, would you say there are conducive conditions for equity capital raising opportunities? What are the challenges that listed companies like Okomo and USC PLC face in using the stock market as a platform for accessing growth capital? Is the market serving a good purpose for your company? Fola, could you kick off with that, with a response?
Thank you very much, Deji, and thanks to Dr. Usman for putting this together. Deji, I was going to say that the conditions are currently challenging, but I know that you said they've been challenging for 20 years. And I'm going to take Funsho up later on his comment that there are no quality issues. I'm sure Kuma and UAC would argue that there are quality issues. Look, I think from our perspective, in ideal circumstances, raising equity from the capital market to be quick, relatively certain, and at attractive valuations. I think this is the thesis for going public with the attendant obligations. Now, the challenge that has been framed, I think, quite extensively already, is that investor appetite for equities remains low. It's reflected in trading volumes and valuations of companies listed on the exchange. Now, there are, of course, very different classes of investors. You have the domestic retail, domestic institutional, foreign investors, and they have different considerations. But I feel that the base to create conditions for attractive issuance by corporates like ourselves are the domestic institutional investors. Now, I am firmly of the view that capital allocation is very much the investor's choice. So we have to create a pool rather than attempt to nudge investors towards providing capital towards issuers. But I think there are a number of things that can be done to encourage investor interest. I think one thing that can be done, or one critical element, is broader confidence in the overall macroeconomic environment and policy. Because equities are by nature riskier than fixed income investments. So from a mindset perspective, I think the broader the confidence investors have in long-term macro and policy direction, I think the greater the appetite there'll be for assets that are further up the risk curve, like equities. Another is regulatory process and sort of platforms. I think there's been great improvement. I think you touched on, Deji, about how there was frequent failures in settlement. I think these things are unheard of now. There's been great improvement. But I do feel there's scope to shorten issuance timeframes. I think the world is so dynamic that the time between thinking about doing something and getting it done, the world can be a very different place. I think there's also a lot of big onus on issuers like ourselves to do the hard work of generating sustained performance. It's difficult in tough macroeconomic conditions, and critically engaging frequently with the investing community to provide clarity and confidence in our companies and equity stories, to persuade people like Funsho that there are indeed quality companies to invest in. Now, in spite of the current challenges, which I would say is quite sobering to think that these challenges have been there for 20 years, I think we still remain confident that things would continue to improve over time. and that the capital market to play an important role, I think, both from driving improved governance and reporting standards. I think Funsho already touched on the need for the buy side to do more in driving these standards. I think it's good for us, and it's good for the overall environment for issuance. And I think that this would hopefully drive improved liquidity in our securities, and over time increase the opportunities for us to access capital from the market on attractive terms. Thank you.
Okay, thank you, Fola. I think in one breath you seem to agree with Funsho there, which is to say that as an issuer, you have an obligation to also ensure that your performance is consistent, which is what Funsho talked about in terms of quality issuance coming to the market. But underlying that are the difficult macro issues and many other things. So I think I hope we'll have an opportunity to come back to this. To marry the 2 points, I think there's some interesting perspectives to distill from the 2 points that you've made. Graham, can I have you come in now and just share your perspective? I mean, as the market's provided, or is the market a good platform for Okomo PLC in terms of meeting your aspirations for capital raising?
Thank you, Deji, and thank you everybody for this very interesting commentary and webinar. I must say that I'm coming from a background not like my erstwhile friends who are on the webinar, but as an agriculturalist. And you know, if I look at it basically from this point of view, my simple answer probably to the question is that it's yes and no. That the supply side, there is conducive condition for equity raising opportunities, and there isn't. Why do I say that? Well, you know, if you look at the moment, I think the market is basically flooded with, especially pension fund advisors and managers who are flush with cash. You know, there's a lot of stock that is available, and it is pushing the market prices up, more especially worldwide. We see what's going on today. So, you know, potentially the equity market looks like a good area for us to obtain capital. However, I think there's a lot of provisos to that. The ones that I've basically looked into and feel are important have a lot of them have been looked into and spoken about already. But at the risk of repeating it, I think a lot of the problems that we find in raising equity, especially in the time that we have now, is a lack of liquidity and volume in the market. There's also a perception of increased risk, I think, that is coming through in the market at the moment. People are more, you know, wanting to hold on to their cash for many reasons. Some of them are which, for instance, high interest rates, the devaluation of the currency, lack of foreign exchange, inflation, even deflation to a point in some areas, as well as obviously the pandemic that is happening at the moment. So those are certainly areas that could affect the supply side of opportunity for raising equity. Others, I think, maybe a lack of investors due to a lack of confidence in the markets, and also, as others have mentioned, market concentration. You know, too many people going for too few stocks. The stock market may look big, but in effect, it's probably made up of a few very big companies, and there's not much to look at. So it causes a congestion. So I think those are main areas of concern that I would have in the current atmosphere in terms of raising equity opportunities. And I hope that those points bring more dialogue to the webinar. So, Deji, thank you.
Yes, indeed they do. I mean, I will just join that point to an important one that Fola made earlier, which is from an issuer's point of view, the period it takes, or the time it takes to complete a transaction is just too long. So you recognize that on the one hand, there is investable capital, but at the same time, you talk about liquidity issues and the lack of volume. So it's a little bit of a problem in the sense that there's capital potentially, companies that need expansion capital, they don't get it, and they continue to underperform. You know, so how do we bridge this gap? I hope somewhere along the line we'll get there. Now, the market itself will never be one that will exist if the providers or those who build the infrastructure of the market are not there to do a good job. And I think I've mentioned how if you compare the state of the market today compared to about 20 years ago, it's a world of difference. It's a world of difference. And so my next question will be directed at CSCS and SEC. And it has to do with the market structure and regulation. So my question to you is this, that recovery and deepening of the Nigerian stock market can result either from introduction of new products or new initiatives geared towards improving market infrastructure and trading practices. In what ways are institutions such as the SEC and CSCS offering greater assistance in this regard? So I'd like you to respond, first of all, Haruna, and maybe Temidayo can follow up with his own perspective. Thank you.
Deji, thank you. And thank you for allowing me to speak first before our regulator, so that when he speaks and gives an opinion, I don't have to counter that. At least I get that opportunity to say, well, I didn't know what you're going to say. But I'm tempted to take my answer starting from the questions you asked, the providers and the issuers. And it goes like this, with your permission, operator. Number one, I was once at the Federation of Exchanges conference, and the chairman of the biggest exchange in the world, which is ICE, can't remember his name now, said that a country must have three things. It must have a flag, it must have an army, and it must have a stock exchange. Now, why is the stock exchange very important? Because that is an aggregator of capital for it to be used over and over again to create wealth and also to create production. Now, in putting that into perspective, certain things have to be in place. I know, Deji, you talked about past 20 years return on 15 and 10 and also 5. You know, in a market, you need distribution. So if an issuer like Graham wants to raise capital, how does he do that? He comes to an advisor, or an advisor goes to him and says, I've looked at your books. You're leveraged too much on this side, or you need equity, or you need a bit of debt, you need to release something. And he says, I think this is the way your balance sheet should look like, and you need to do X. All of the things he's saying, or the advisor is saying, has to do with restructuring that balance sheet, which is a capital market activity. Now, to do that, you need to have a level of sophistication to be able to. I think there's a bit of background. So a bit of sophistication in terms of products, and a bit of sophistication in terms of the participants themselves understanding what you need, and also bringing the investor to match what it is that the product will bring. Very important. Before we even come to infrastructure, I agree there has been quite a significant, discussion around that. The fact that an entrepreneur can go to a bank and get financing in 3 weeks, but when it comes to the capital market, could take him 6 months to 1 year. So the turnaround time exists, but I think there has been significant improvement by the SEC in terms of how these things work. I think getting shorter and shorter and shorter, but that's also a factor. Now, an important aspect of the capital market is credit. Banks, in 2007, 2008, when I used to be CEO of UBS Stockbrokers, Tony, you remember, we used to trade in $100 million a day. You ask the question, why could we trade $100 million a day in the market? It's simple. The banks were in it. They were lending, even though in a different structure, which everybody got hurt, but you have to have the banks in the system. They got to be lending. Right now, the market has gone. The volumes are like, day first day was 18 billion naira or thereabouts, a trade. I haven't seen that in a very long time. Guess what? We are beginning to see more and more lending starting to happen again, because now there's opportunity, and then you see liquidity. Liquidity doesn't come from just investors. It actually comes from banks. Lenders actually fund the market. Now, also, products are very important. You need to have the right products for you to be able to hedge and create value for either as a fund manager or as an asset manager, or even when you're doing private portfolio management. These things are very important. Now, the issue of governance, I don't doubt that. I mean, governance is key to, because the market has to be trusted. And the trust doesn't just come from the issuer, it has to come from the advisors, to the participants, to the infrastructures themselves. There has to be transparency in how things are done. And which is why policy making becomes very important. In many years that I've been in this market, about 25 years, I don't see any budget. I've not seen, well, maybe there's a mention lately in the last 2 or 3 years, mention of the capital markets at any point in time when a finance bill is being passed. That's why you need policy to help stimulate the processes in how markets work. The issue of cost is there. How do you ensure that the right cost is being allocated across so that the market is not expensive? Now, for infrastructure, we only come post-trade. So all of these things I've mentioned have to be there for the infrastructure to function appropriately. And at CSCS, I remember back in the day, I don't know whether there's an older broker here, where when I was my first job at the stock exchange in maybe 93 or thereabout, brokers used to exchange checks on a Friday to settle. So if you don't see a guy who owed you money, who left early, that means you're out 1 week. And the CSCS was brought in as a clearinghouse and settlement house to be able to take away the risk of settlement in the market, which it has done significantly. Now, the investments have not been made over the years up until about 3 or 4 years ago to improve in terms of technology, operations, customer care and service, and more importantly, around KYC. KYC is very important. And we're just going through a round of, and thank God, the SEC was very strong around not moving the date on ensuring that we have KYC done in our market. It's key because you have to have an identity for you to trade. You need to know who you are, not even from a AML CFT perspective, but just even from fraud. So infrastructures are there to support markets, and to be honest, a lot of investments have been done from the CSCS perspective in terms of, like I said, technology, operations, people, even to the extent that right now, APIs are being built, registrars are connected to us directly, brokers are beginning to get single APIs, and OMSs we're working with to have those APIs deliver individually to brokers across the market. Those are the things that happen. But then you need to make those investments. The investments come from when the market is growing so that we can also make investments. So there's a correlation between how successful the market is and how good the infrastructure is, because the infrastructure fits from the market and the market fits from the infrastructure. But certainly, it's a very important aspect of how markets work. Post-trade has to be there. It's what gives markets trust. And typically, post-trades work with, or infrastructures work with SECs, regulators, to create rules and laws across everywhere you go in the market, because they see things after the fact and can help. Thank you, DJ. I'm sure I've taken too much time.
Well, thank you, Aaron. So what I would say to that, there's a case of a chicken and egg. You don't quite know which comes first. I think if you only just started trading in the market in, let's say, year 2000 or 2005, you don't quite appreciate how far the market has gone. And I think one of the, I'll call it a revolution, was the introduction of CSCS and the improvement it brought about, in the 90s. If you trade in a company like Guinness, or any of the blue chip stocks, 5 out of 10 times there will be settlement failures. So, but today, that's so I think at times we don't really appreciate how far we've come, and we need to learn to continue to build on that. But there's still challenges for institutions like CSCS. Timida, can you share your perspective on this, please? Thank you.
Okay, thank you very much, Mr. Ali, and I'd like to thank you to Susman for putting this together. So quickly put, on the SEC side, in a couple of things that have been mentioned during the course of our discussion, it touches on so many things: governance, investor confidence, deepening the market, and a lot of things you have to weave into one. You have to balance diligence with speed, and on the regulatory perspective, you are catering for both the investor and the issuer as well. And there are a couple of things that matter to the issuer you have to address to, and you have to match that with the investor that is coming in terms of protecting their own investment and ensuring that they keep coming back to the market. At the end of the day, both ends of the prisms, they want to see value. The issuer wants to access the market, knowing fully well I can access the market, confidence I'll raise the money in a timely fashion. The investor wants to access the market, knowing fully well my money is safe, valuations reveal full transparency and full disclosure. And in the middle, like a main arbiter who is meant to develop the same market is the SEC. So I'll give you a couple of several things that have been done by the SEC over the years that we keep improving on. One, from the issuer perspective, time to market. And I hear when Funshaw and Folashape mentioned about issue of time to market. Now, where we were is not where we are at the moment. Things are, well, I don't know whether I'm allowed to blow my own bubble myself. I know it's getting better. Of course, there could be more things. There are more things to be done. We've tried different things, including allowing for electronic submissions. I mean, that is obviously the way to go. And even going through different levels, I mean, going through the checklist process and shortening the process, time to market for different variants of issuances. Now, what does that speak to? It is not about just the timeliness to market. When you can access capital in a more timely fashion, the issuers are more likely to depend on the capital market. When they are more likely to depend on the capital market, it creates an avenue or an opportunity or an environment for more innovation, because the advisors and everyone around the table, all the stakeholders, we want to create more new avenues that these same issuers can come into the market. Now, on the investor perspective, once you have a broader and a deeper market, you have more things, more innovative ideas or newer ways of doing the same old traditional things. It broadens your options. It lets you diversify. The risk is further spread, and everyone is better off for it. Then you can galvanize or just, should I say, recruit more capital. And the capital can then now start leaving even the traditional things to more longer term sort of investment, like the infrastructure, which our country really, really, really needs investment and into it. Now, let's talk about that. And I know one of the things that have been the sort of concern is about the, should I say, progressively aging populace of investors. And CSS shared some interesting statistics with us not too long ago. And we're looking at about even the breakdown of investors in the market and the aging profile. And now that comes to speak to, if the profile of investors is now looking northwards of 47 years, what are we doing to take care of the younger ones? Now the younger ones, now we are even talking about time to market. I mean, I will use the word my age bracket. Now we are so even impatient. Anything that loads later than 1 minute is taking too long. Anything that loads on your phone later than 1 minute is taking too long. Now that creates another avenue which the SEC is looking into. You may be aware, about a month and a half ago, we gave a stand that we're going to be looking into the digital asset space. And that is where, I mean, it will interest you to know. I gave this statistic at one of the podiums I was talking on a couple of weeks ago. For the collective investment scheme, we have less than 500,000 unit holders. There's a particular digital exchange which claims to have had over 800,000 new additions to its own platform. So we're supporting and we're looking to create or support innovation in that wise. And how do we do that? We just create the rules around it. We create an enabling environment such that people going in there know that there's a regulator that is looking into that space, making sure that it's not like out of lack of knowledge or shortness thereof, people can be fleeced. And again, another thing I like to mention is about the governance. I heard a very interesting point on shareholder participation. I mean, governance is one of the ways to go. At the SEC, we look at that. All of this and all the things I mentioned, it engenders confidence. When you have a regulator that is up and alive to its own duty, checking the governance, making sure everything is right in place, and you are focusing on development as well, creating an enabling environment, making this issuer, access capital, number one. And how can they access capital? There has to be investor for there to be capital in the first place. So you develop things on financial literacy, you empower even the potential investors, make sure they are not totally out of the market in terms of knowledge, and they can ask the right question. So even before it gets escalated to the regulatory level, they themselves have put their own directors, their own, should I say, workers, who they have invested in and they have employed indirectly by buying the shares of the company and putting them to task. I think one other thing I like to mention is what a couple of things that Jalo touched on that, identity management. You know, and I just got back in from the House of Reps, and we're having this public hearing on a clean dividend. Those are the kind of statistics when you hear could be quite discouraging. That, oh, even if I put my money there, I don't even know what happens there. And even when I know what happens there, I don't know what happens to my clean dividend. One of the things we have traced, and we narrowed it down to, there are several major factors, is issue of data, identity. You know, a lot of things, and CSS has been working with the Association of Stockbroking Houses, and we've just made it very clear. If you are fit enough to trade, you are fit enough to update your data, so that all of this other noise that we consider around the communication is we want to grow the market. The market has to be efficient. Issuers have to access money quickly and investors have to get return. The noise is when, as a result of not doing something, your dividend doesn't get paid. As a result of not being financially literate or being aware of some statistics, you don't ask the right question, and governance gets thrown away, and that further undermines investor confidence. I mean, there are quite a couple of things. I hope I do still have opportunity as we go on to touch on other things the SEC is doing in that regard. I'll leave it here for now.
Okay, thank you very much, Semida. I wish we had the opportunity to really talk to you, because I think you have very important points and contributions to make in this discussion. You know, when you look at the whole thing, the banks have money, but won't give it to the entrepreneurs because it's not their business to finance risk. The pension fund managers.
You've got on mute. You've got on mute.
Oh, sorry, apologies.
Deji, we seem to have lost Deji.
Oh my God, I didn't realize. Beg your pardon. Okay. I was speaking to myself.
Okay.
Right. Okay.
And you have just about say 3 minutes to round
all right.
up.
Okay. Okay. Yes. So I think we'll just come back to it. Hopefully, we'll have an opportunity to. I'm hearing myself. We'll have an opportunity to touch on some of the important points you've made, Temidayo. But I think the digital space that you touched on is one that I think can make a connection with the younger population who have been left out in the last 10 years or so. So in trying to, sorry, this is echoing. I think there's somebody that needs to mute. Okay. In trying to round up, I'll just try to ask one last question, if you will. And this has to do with this whole thing. Capital or money serves no purpose if it doesn't bring about positive growth to an economy. There's no point in us saying we have 11 trillion under management if that money, that pool of capital, given what Nigeria is going through, does not make a contribution towards Nigeria's progress. And I think perhaps at times what we haven't done well is joining the dots. And so my question to you, looking at things in terms of where we need to take this country, the need to drastically reduce Nigeria's infrastructure deficit represents one of our overriding goals, and that's of the current administration. With the government's current fiscal challenges, what are some of the steps that Nigeria needs to take to successfully leverage the NSC platform as a funding source for infrastructure delivery for the country? Because what we're doing right now are not passages from the Quran or the Bible. I mean, and so we have the powers to change the laws, to make that connection, to create equity capital that is long-term, and so on and so forth. So my question really is, what roles for the market operators and regulators? Is the market ready for this kind of opportunity? Fola, would you like to share your perspective on this?
Thank you very much, DJ, and I'll attempt to do so in a rushed fashion because Dr. Usman has told us we don't have much time. I think your starting point is a fascinating one. We have all this money, and how does it aid development? For me, it triggers a one level up question. To who does the investor owe a duty of care? And I think it's a fundamental question that the PFA community and any asset manager would ask. And the narrow answer is to the contributors to those investment schemes. And so in deploying capital, they need to believe that there will be a return, or at the very worst, no impairment of capital. Now, there's clearly a gaping infrastructure need, but fortunately or unfortunately, infrastructure is a long-term game. And so these investors need to believe that if I commit to a scheme, I will not have any nasty surprise in 10, 15, or 20 years. I think another challenge is that the capital market investor, I call them, and I apologize in advance, distracted investors. They have a massive universe of things to look at and don't have the time or incentive or mandate a private investor has to sort of go through the weeds. And so there needs to be confidence in a broader asset class. So infrastructure investing needs to establish itself as a broad asset class. And unfortunately, every early setback from an infrastructure project affects that journey towards establishing infrastructure as a viable asset class. I think once the asset class is established, you will then find capital flowing towards the class and therefore specific opportunities. So in summary, what I think needs to be done is government agencies and regulators need to appreciate and put in place long-term stability supporting infrastructure projects so that capital can flow. We've seen investors would very happily invest in a 10 or 20-year government bond because the class is established. The work needs to be done for infrastructure. And I think given the need and where we are now in that journey, maybe there need to be enhancements for a few test cases. I don't know, capital guarantees, tax incentives to enhance yield, but no investor invests with the aim of calling a guarantee. Over time, the work has to be done to give people the confidence that if I put my money into a road, rail, or power bond, in 15 years, there'll be no nasty surprise around policy regulation that affects my ability to get that capital back.
Thank you very much. Very quickly, Aaron, if you don't mind, I'll just give you a minute because we're out of time, so I can.
This is very simple. I think this is very simple. You know, it's about trust. It's about consistency. We need to know that an investor, you know, private capital has to be protected. If we don't protect it, it will go somewhere else. And we have to have the structure and the policies, consistent policies. I'm saying, you know, I'm not talking about just policy within the capital market itself. I'm talking about policy in agriculture, for example. Graham tomorrow can wake up in the morning and they'll say, okay, sorry, there's no palm oil that you can sell within a Edo State or something. Okay? If I'm an investor, I have private capital. It's my money, it's my savings. I'm coming to come and save. I need to have that perspective that capital is first protected. Second, that whatever I'm investing in, I take that risk, but let it be a risk that I can calculate or can predict in terms of outcome. Not something that if I'm writing an algorithm for a trade, for example, I can't put those, you know, variables in any context that will create a trading, you know, a style that can be consistent. So if you ask me, we need to know how to protect private capital in multiple ways, and you unlock what we're looking for in this market. Thank you.
answer all questions. In the meantime, we need to continue with the second panel. And it's my pleasure to invite Wisho Akere to start the second panel. Funsho, over to you, please.
Thank you, Dr. Osman, and good afternoon, ladies and gentlemen. Welcome to the second panel discussion titled Beyond Equities, which will focus on the other asset class outside equities. Just a very quick point, just to clarify, that my comment on the equities section was not that we didn't have quality issuers. You know, we certainly have quality issuers. It was that we actually didn't have, there was a dearth of issuances. So we would like to see companies like UAC come out to raise, to do a large public offering to fund an acquisition. Is really where we would like to see the market so that we can deepen that market. So I just thought to clarify that point. So just jumping straight into the second panel. Look, we've seen a significant growth in bond and commercial paper issuances with about 700 billion only in commercial paper issuances this year alone. We've certainly raised, well over 400 billion naira for our clients. There's an increased focus in sustainable finance products from both local and international institutional investors. And if you're speaking to any international investor, you just need to mention the word green, ethical, sustainable, and you have their undivided attention. Private credit funds are quite popular in most developed markets, same for real estate investment trust and schemes. M&A activity is the bedrock of most capital markets, largely because it spurs both equity and debt capital market activity. Mr. Ali and Fola talked about infrastructure bonds in the last session. We didn't have time to talk a lot about it, but this is a session where we can go into a bit more detail. Thankfully, I'm not alone. We have an experienced panel to give us their thoughts on what could be a significant driver of capital market activity in Nigeria going forward. So I'll start with allowing each panelist to share their quick thoughts on the subject. I have my stopwatch in hand because it's a very short session. So if we could just have 2 minutes, quick high-level thoughts on the subject. I'll start with Ms. Amin.
Good afternoon, everybody, and thank you for having me. My thoughts about the capital market is that we need to deepen the capital market, and I feel that the most important thing for us to do from the start is to create awareness to the issuers. To the issuers means to the government, state governments, for example, and corporate entities, to be able to make them know that there are ways which you can be able to deepen the capital market, create awareness for them to say, for example, Sukuk is a way of bridging the gap for infrastructure, for example. I am from Borno State, and I know that for sure we have a lot of deficit. We have a lot of people that do not have jobs, and these Sukuks create multiplier effects, for example, where you see that if the government goes in to raise funds through Sukuk, then of course there will be a place where you have to get everybody involved. Then we won't have the Boko Haram people, because everybody has something to do. That's what Sukuk does to you. It creates a multiplier effect from the owners of the Sukuk to the downtrodden, to the market, to everywhere. Everybody gets involved. And then apart from that, I would like to say that for corporates, again, for like Dangote to be able to be aware that, okay, you can be able to do Sukuks and create awareness for the capital market. I feel that if there's a lot of awareness, then we will be able to see bridging the gap for infrastructure deficits in Nigeria. And then I also think that because SEC has a 10-year master plan, if we delve into that, we will be able to, they've created awareness in Sokoto and Kano. If they can go further and say, okay, this is what we need to do, what we should do, then it will be okay for the capital market.
Thank you very much, Ms. Amin. I'll move over to Mr. Babayo.
Good afternoon, everybody. I'm glad to be part of this important webinar. And we're really discussing important issues that really concern our country. First of all, I will be specific to my own area, which is pension, essentially in pension fund administration. And you can see currently what is happening in the country today. We have 11 trillion that is actually not really utilized the way it should be. As of today, I think interest rates, the traditional money market that we put the monies here and there, interest rate has gone down to, in some places, less than 1%. In a way, it's good for the country because we have to start thinking of alternative asset classes. And we have to start thinking about investing in all these alternative assets. But as it is with our country, it's always transparency, regulation, especially policies. Like other speakers have said, policies. It all goes down there. I can give an example where in 2007, pension funds, we invested in REITs, real estate investment trust schemes. I think there were 3 currently in the market. They are underperforming. The alternative asset class, that is seriously underperforming. We wanted to exit from some, we could not get out. 6 years after South Africa rolled out their own policies for the real estate investment trust scheme, as I'm talking to you today, South Africa has 30 of such scheme running smoothly and making a lot of money, despite the economic problems of South Africa. So these are things that we really need to deepen the market. There must be transparency in the market. There must be trust record. Because essentially, as pension fund, we are custodian to RSA funds, people that are keeping their money, that they look for their golden years. You know, you cannot, we should be risk averse. In as much as we want to invest in such schemes or in other equity funds, we need to be careful about people's money. And this one boils down, in most cases, unfortunately, the risk of being sanctioned. Government, in most cases, default. The Lekki concession issue is one. You know, there are several that I can cite.
Babayo, if you don't mind, if we could just move on to the next participant, we'll come back to you because I think you're
okay.
You're
ahead of my time. All right. Okay.
But you're touching on some very important points which we need to unpack. Yes. So if we move to Mr. Ideahi.
Thank you, for sure. So we talked a lot about equities in the earlier panel. We talk about equities, they refer mostly to common shares in that sense. So not only is it a way to broaden the market, focus shares, but also looking at other types of equities. For example, pref shares are one where we can actually introduce to the market. Pref shares that probably tie in guaranteed or fixed returns on those pref shares. That's something common in other markets. The other instruments, like has been talked about in the earlier conversations, like REIT, we are increasingly looking at mortgage-backed securities, options, and derivatives, and other type of derivatives are things that can be introduced to the market to help the general capital markets.
All right, thanks very much, Eric. Can we move over to Mr. Bisson from the SEC?
All right, okay, can you hear me? All right, thank you very much, Funcho. So I'll just put it all on the floor. So beyond the equities, so one is the commodity space. Right? Commodities, there are things, I mean, agric is as long as I've been studying economics, so even right from secondary school, has been the largest employer of labor. So commodities, and we know that mining and extractive industry is coming up. I mean, we were all watching due to the TV when the first bar was formally presented to the president. Now, so commodities is beyond equity, but something we should look to grow. On a quick pace, several years ago, maybe like 10, 15 years ago, I mean, the only commodities exchange we had was government owned. Now we have two others that have come up, and they are doing quite a couple of interesting things. I mean, I won't be surprised in the next couple of months, we start seeing more robust trading and more products coming up from that end. And the FCC is already in that space, and we're working with them, creating enabling laws, rules, empowering, giving the necessary permissions and licenses for that space to thrive. Secondly, fintech. Now, a lot of people, you see that it's either side of the table you are sitting on. Either you see a figure of 6 or a 9. A lot of people will say fintech, they are just enablers. They are just enabling the traditional. Some people will just make very solid arguments that you could create new products out of fintech. Whichever way, I spoke about it in the last session. The SEC, we made a bold stand. We're looking into that space. In a couple of days, we're going to be releasing regulatory incubation guidelines. When we want to attract these people, let them come, let them see what you're doing. And before we finally license you, that will do a lot of things. Will enable us to understand. By that way, we can better protect the people that are coming into that space. By that way, we can regulate and moderate the potential risk that they could go into. Now, another thing is...
I was going to say, just because we're running out of time, if you just, we will come back to you and maybe if we have a bit of time to find out what you're doing to ensure that we, especially in the commodities and the fintech space. So I think we'll definitely have to come back and unpack that. It sounds very exciting. So I think I'll go quickly to Mr. Usman to give us his quick initial thoughts.
Thank you, Funsho. I think overall, what we need is very sound policies, consistency in application, benchmarking best practice, especially when we come into this alternative class of finance. Many countries have taken a plan over a horizon of say 10, 20 years and put specific timelines and growth trajectory that they expect for the alternative finance. When you talk about Sukuk, the Islamic real estate investment schemes and Islamic exchange traded funds, the mutual funds, it would have identified what type of growth do you want to see in this sector, because it's diversification of the market. And then all the regulators will then be working together and supporting by providing the enabling environment, the necessary infrastructure and regulation that will propel the operators and participants in these markets to be able to achieve those specific. So I think the 101 is proper planning, sound economic policies that ensure also that savings are enhanced through full or reduction in unemployment in the economy. So that way you can be able to deepen the market, because people have savings and so they can be able to subscribe to the available products that are being offered.
Thank you. Certainly an exciting start. I hope the audience are excited as I am, because I mean, with what I'm hearing, there's just lots to talk about. So I would kick off by asking Mr. Babayo a question, and we cut him short. He was getting on to something that was really interesting. He talked about PFAs, having about 11 trillion under management. And we know that there's been a push to get PFAs to invest in critical infrastructure projects. So I'd like to get your thoughts on how this project should be structured in order to attract sizable PFA investments, and perhaps just close the loop on the conversation that you had started earlier. Mr. Babayo.
Thank you, Funcho. Like I was earlier saying, we need policies. We need policies to unlock the potential Nigeria has. A very good example is the Malaysian example. The Malaysian example, they had the right policies. Most of their infrastructure, especially roads that you see told in Malaysia, they are funded by most pension PFAs. In Nigeria today, what we needed, like all earlier speakers have said, was consistency in policies, transparency, probably government, like somebody earlier on suggested, there has to be some kind of protection for if PFS, we as PFS, if we are to invest in infrastructure, we need to have some sovereign protection against future, because there are so many policy somersaults in Nigeria, to be honest, that does not encourage long-term investments. You invest, like supposing you invest in an airport or a toll route, express road, turnpikes, you are expected to maybe in 15, 20 years before you can see you could your investment. And then suddenly another government comes with populist ideas and tells you, we are opening the tolls. What do you do? So we need some kind of protection against such that. And then the other issues I was talking about also, not only look at the public side, we also, even on the private side, there's not much transparency in most of the people that want to come and benefit from the pension funds or this and all other alternative assets. That's why we are a bit skeptical about investing there. I gave you an example of REITs. There is not much transparency in that. 2007, we thought the people that came out with the REIT scheme probably had some track records. But unfortunately, I don't know whether it was you who was talking about shareholder activism, that some of these MDs should be, maybe it's just lack of transparency. You can't determine the price. You want to exit, you can't exit. They are all underperforming. South Africa, with all its problems and whatever they are there, they're doing well. There are about 30 REIT schemes now that are being, they are performing well above this. So if you compare to other our peers, we are doing badly. That probably there need to be some sanctions. I'm happy some of the regulators are here. SEC is here, so these are some of the things that I think the pension fund would like to see. Okay. There is also the ethical fund that is coming up, but it's being bogged down by regulation. Our regulators are yet to give us clear-cut guidelines on them. So for now, I think this is what I can tell you, that it all goes down to policy, government regulation, and whatever. And okay. we need to also, as a group, probably push for legislation that will take care of things like this. Thank you.
Thank you. I think if we have a bit of time, we'll come back to the issue around ethical funds.
Okay.
What needs to be done to kind of have pension funds invest in yes.
The Sukuk, sorry to cut you short. The Sukuk has shown that this sort of funds are quite attractive. Sukuk is a success in Nigeria.
Yeah.
We as PFS invested. Last time, even what we subscribed for was not given to us. It was like 30% or something that was given to us. So Sukuk is quite a success. And the projects are being seen done. So that is one side that should be strengthened. Yeah.
All right. Thanks very much. Okay. So moving over to Eric, insurance companies play a very important role in the capital markets as long-term institutional investors. I know you wear many hats, but if you wear your hat as chairman of Tangerine Life, you know, what do you think we are missing? What other asset classes apart from equities and, you know, federal government securities do you think we need to develop to attract interest from insurance companies?
So some of the things we'd like to see are more long-term securities, mortgage-backed securities, for example. On the insurance, Tangerine Life, for example, we're very big in annuities, or we've been doing quite a lot of annuities. And with that kind of product, we need long-term securities or long-term instruments that we can actually back up those annuities. So an instrument like a mortgage-backed security, for example, which goes 10 years from 15 to 30 years, that would be a very good instrument to have. There are some other things that we'd like to have that track the market for funds, more exchange-traded funds or index funds that track general market performance would also be beneficial to us in that sense. So a diverse set of assets would help us develop our portfolio a lot better to serve our clients.
Thanks very much, Eric. We'll come back a bit to unpack that in a bit more detail. Moving over to Ms. Amin, you chaired last year's African International Conference on Islamic Finance. How can we deepen the capital markets via Islamic finance instruments?
Thank you. The last year's conference, the theme was infrastructure, financing, sustainability, and the future of the African markets, which is very, very much what we need now. So we brought captains of industries all over around the world to be able to come together and see what we can do with Islamic finance and deepen what we have in the market, capital market. And from that, we were able to see that infrastructure development is one of the key issues. And we took away the fact that we need more awareness in Nigeria and that we need to fill in the gap, because like this year's budget, it says 10 trillion plus. So what's the deficit? If you look at it, if you use Sukuk, for example, to be able to key in that area, then we'll be able to raise a lot of funds. Federal government has been very successful with the Sukuk 1, 2, and 3. Fortunately, we were also part of the advices, and I know the oversubscription. All of us in the capital market know that it's been oversubscribed, and a lot of other entities are looking at the Sukuk market, which of course is going to flourish in the next decade. Nigeria has done so well when it comes to Islamic capital markets so far. And I feel that this is an area which we need to focus on to be able to see that infrastructure strives in Nigeria, drive infrastructure. The African International Conference also deals with fintech. We had a fintech showcase where we showcased Nigerian young entrepreneurs to come and pitch. And it was really beautiful to see that people are keen into fintech as well, which is what the world is going around for. So these are the things we try to see if we can pitch at the African International Conference. And for that theme, every now and then we see that it is what is needed in Nigeria: infrastructure financing, and so how it can be sustainable. How it can be sustainable, I had said from my from my earlier comment that you can be able to drive employment, you can be able to drive social infrastructures. You can do anything with Sukuk. You can build hospitals as it's been done. You can even build prisons if you want. Just like Sukuk is also trying to do a PPP sort of, and that is what we also try to learn at the conference. And I feel that Nigeria should focus right now on that, and with pension fund coming in, for you to be able to key in as a Muslim, for example, you can be able to key in your pension fund to be invested in that. And we see a lot of equities rising, funds rising. The Lotus Capital Halal Fund is doing very well so far. it can be equated to the normal funds outside the conventional market. So I feel that Nigeria should key into Islamic finance structures, and we will see a lot of changes.
Thank you. Dr. Osman, it sounds like we probably need to have another webinar where we, unpack, the sukuk and other ethical products, because it sounds like there's just so much that we haven't discussed, or there's so much that we wouldn't have time to discuss on this webinar, but it's certainly an interesting, subject that we need to unpack, which can help deepen the capital markets. Okay, so moving on to the SEC, Mr. Obison. I mean, I think we're fortunate that you operated on both sides of the market, first as an operator and now as a regulator. And the question to you is really how, given your experience, how can capital market operators partner with the SEC to introduce new products or innovation that deepens the market, to overhaul or shorten the regulatory approval process, such that you can launch transactions and complete them in the space of a month or two?
Okay, thank you very much, Funsho. And that's very, very, in fact, it's an opportunity for me to just air some views. So, number one, let me start from the second bit of the comment or your question, which is how to shorten the regulatory approval process. I mentioned something earlier, the speed, which is about just shortening the time to market or making it more efficient. Then on the other side is diligence. You have to look through clearly. Now, on the one side, you could amend the process, the procedure. On the other side, when the turnaround time, so I'll say for the SEC, let me start with the SEC. First is we continually look, and based on the feedback we have with market operators through different channels at the Capital Market Committee meetings, we started meeting with the trade groups to speak with them, to hear directly. And of course, we are looking to even engage issuers more directly now, so we even understand how efficiency in our processes could be better achieved. But the other side as well is the quality of submission from CMOs and shortening the time to respond to issues or queries or clarifications sought. Do I think the process could be better enhanced? 110%. And it's always, you just have to keep evolving. It's not a one and done situation on that side. But on the other side, which is the first bit of the question, how to even encourage. Number one is we will continue. You need to, as a regulator, constantly look at the environment, creating that environment, enabling laws, making sure there's protection, making sure every identified area, should I say, angle of a transaction are well looked at, well taken care of, and then enshrined in the procedural form so that there are no hidden surprises. And if there are any, it's promptly and quickly dealt with so you don't stifle innovation. A couple of things have been said on this during the course of this webinar that I think are quite important. Adopting new ways. Product creation is one. You create a product with the clear view that there's going to be a market. That means that market needs to be aware. That speaks to distribution. That means that market needs to be informed. That speaks to literacy. And those are the kind of things, areas that the regulator will continually look into. A lot of us, they said about Sukuk has been a very brilliant source of financing. I mean, a couple of the financial lab centers, they use non-interest or Islamic products to finance long-term projects, given the nature of the underlying characteristics. So those are clear areas that the regulator needs to constantly keep improving on at every point, at every opportunity. Now, before I just close, being on the operator side And now, well, I'm just 4 months into the regulator side, but a couple of things are quite clear. It is a clear collaborative effort because it's a chicken and egg situation. The SEC is meant to, one, regulate, two, develop. If there's no developed market, eventually it will fizzle out and there will be nobody to regulate. So we take that very, very seriously. It's at the heart of what we do. And I mentioned earlier in the earlier segment, there are two sides. There's the issuer and there's the investor. The needs are quite peculiar, but you need to harmonize it and balance the grid. So that's where it is on the market side. Prompt responses to queries or clarifications that are required. And on the regulator side, keep refining the process so you don't end up playing catch up. You are just matching at the very minimum the same pace with the issuers or the market, that's the CMOs, the capital market operator. However, there must be a good balance between speed and diligence. I'll leave it here.
Fantastic. I think it's music to our ears, for capital market operators. And I know you talked about financial literacy, and Mrs. Sani from the previous panel, has, done, her and her committee are doing, some great work in, trying to improve financial literacy across the country. So I'll come back to Mr. Babayo, and on, we know PENCOM has approved the non-interest RAC structure, and then you talked a bit about it, but we're yet to see that more traction from PFAs. I know you started talking about, what needs to be done to get PFAs to invest in ethical products, and if you just, in 2 minutes, just quickly also tell us what other products do you think, PFAs should be looking at to earn a positive real return?
Yeah, thank you. On the ethical fund side, I think some work has been done, but all we are waiting now is for PENCOM to give us the green light to commence, because I know some of the PFAs have started doing some. You need the advisory board that are knowledgeable on Sharia compliant finance products. That is all I can say for now on the ethical funds. But as PFA, especially during this COVID, it has really opened our eyes. So many things that we can do in Nigeria with the regulation. Now I don't see any reason why we should not have an equity fund for healthcare. Maybe on all this geopolitical, a fund like that, pension funds contribute into that, build world-class hospitals in all those things. And these things, I believe, in the next 10, 15 years, will pay back this money and it will save our efforts. These are the things but all these things we have not really happen without the right legislation and the right government policy. So we are custodian to people's retirement savings, so we cannot toy with their future. We have government doing everything now is almost gone. Like we said, this 11 trillion that we have.
Okay.
I think you are the one who shows that you get for your deposit money market 15%, and this things, you put it in treasury bill. It was a time, a point in time, it was up to 12%, 13%.
Yeah.
To get money from government, borrow it back to them without doing anything. That is a lazy way of doing things. We cannot grow an economy like that. So what is happening right now is a signal, and I really, Mr. Obiseson from SEC, you are here. It's an opportunity. It's a golden opportunity that the money market is down in the price, because we have to look at alternative assets that will grow this country. We have a lot of infrastructure we have the population. There are so many things we can do. And once we unlock the potential, all these things will become history. So this is my take. Yes, yeah.
Thank you very much, Mr. Babayo. I think that's extremely useful. I mean, you touched on the point about, things, I mean, the interest rate environment is changing and rates are on the decline. I mean, treasury bills today are under 1%,
Exactly.
21 years, I haven't seen that. So I'll move on to Eric. I mean, Eric, low interest rates are important for acquisitions because, from a private equity perspective, you can create value for, institutional investors like PFAs and fund managers. Now in this market, we haven't really seen hostile takeovers, and we talked a bit about shareholder activism, and that's been important to drive value creation for investors. What needs to be done to get, private equity funds such as, Verod to work with institutional investors and be more active in driving, hostile takeovers that create value?
So first of all, at Verod, I think we strongly believe that no deal with. So it's not something that a hostile takeover is not what we do. But I guess the other side of the question is what can get investors participating in M&As. As a firm, we've Verod, we've done 2 or 3 M&As this year over publicly listed companies, and delisted those companies on at least 2 occasions. Today, with the current market environment, low interest rates, starting to see natural occurrence, more and more PFAs, more and more institutional investors reach out to us and reach out to firms like us to see if they can partner with us. Such. So I think the current environment is more for natural progression, transactions happening with debt or being done partly with debt. So I think it's going to be natural progression, but it's something that is forced upon. But the more players like ourselves, there are not too many private equity firms out there, or too many credible private equity firms in the markets. But the more firms like us pop up, the more not just equity capital, but debt capital to partake in transactions, or do transactions where you're seeking great returns because of such of taking advantage of such low interest rate environment.
Thanks very much, Eric. I will move over to Ms. Amin.
Sure, you need to wrap up in about 3 minutes.
Okay. Yeah, that's fine. So, Ms. Amin, if you just give us your closing thoughts and maybe just tell us how you see sustainable finance evolving in the next 3 to 5 minutes. If you could please do it in a minute.
So the last conference, again, I'll come back to that. His Royal Highness Muhammad Sanusi II was the keynote speaker, and he talked about the challenges he faced when he wanted the Sharia compliant structures to come up in Nigeria. Some people were even saying, oh, he wants to Islamize Nigeria and all that. But there has been significant and very remarkable changes. According to IFSB reports, says Nigeria has superseded other countries like Senegal, Gambia, and even South Africa when it comes to Islamic finance. I think JAI started in, the first Islamic bank started in 2011. I'm not sure of the date yet. But from then up till now, we have like 2 standalone banks, Jaiz and Taj Bank, and we have another approval in principle, Lotus Bank. We have Islamic Bank Windows, we have the Sterling Alternative, we have SunTrust Bank, we have fully operational Takaful companies, that's Islamic Insurance. We've got about 4 of them. We've got Jaiz and Nur Takaful. Now we've got Cornerstone and Salam Takaful. And then we have operational fund managers, which is Lotus Capital. Then fund management firms, again, we have the Trust Bank and now 117 Capital coming up. We have corporate investment advisors as Burak Capital and Lotus Financial Services. We have Sukuk issuances in public. We have the Osun State, and we have 3 federal government Sukuks so far. We have halal funds registered with SEC. We have the Lotus Halal Fund and Lotus Fixed Income Fund, and other funds as well. We have mutual funds, United Capital Fund, and we have Islamic REIT, which Chapel Hill did, and we also have infra credit with annuity PPP, which is Sharia compliant. So for Nigeria, I see there's a lot of development, and with the pension fund, from reports and surveys, we see that we have about 1.5 to 2 trillion for as asset managed with under Sharia compliance when it is allowed for the pension fund to give in. So I feel that in the next 3 to 5 years, Nigeria is going to be the hub for Islamic finance in the whole of Africa. And I'm very optimistic that it will be for the good of the people. Thank you.
Thank you very much. I mean, it sounds like there's the buy side with the funding and we have the product. So it's now how do we, create the supply side so that, you can then get the market firing on all cylinders. Dayo Bisson, I would give you maybe 30 seconds to a minute to just tell us what you're doing. You talked about fintech and commodities and give us your closing remarks. And then we will go through Mr.
Sorry, I think, Funsho, I think what we'll do is let's just roll this into the general Q&A.
Okay.
Thank you very much for conducting that section. We promised our participants that we'll take 2 hours. We have just about 20 minutes, maybe with a little bit to do the general Q&A. And what since you had identified Temidayo to be I will start with you as well, particularly hearing that you've been both on the operator and the regulator side. Actually, this question came in from Bibiana Okerafo, and it has to do with the 2020 finance bill, which incorporates the treatment of unclaimed dividends. And the proposal is to turn it into a fund, which if not claimed by the owners after a certain period, will revert to the government to use to finance infrastructure. And Bibiana is saying this is very unfair to the investors. So maybe before Temidayo, let me start with a private sector person, Funsho, and since you are already on, maybe what's your perspective on that, the finance bill's provision for unclaimed dividends? Yes, Funsho.
Yeah, I must say that I haven't spent, a significant amount of time unpacking it. But I think I just operate on basic principles, and the principles really at the end of the day will be that where the dividends being paid out of, they're being paid out of the company's coffers, right? And they're being paid out to investors or shareholders of the company. So if investors don't claim those dividends, then ultimately it should return to the coffers of the company that's paying, return to the company's coffers, so that those returns, or I'm sorry, those the dividends are available then to be used to grow the company or to be paid to other shareholders. So that's my view around the whole unclaimed dividends. I think if it's going to go back to anyone, it should go back to the companies that are paying the dividends out, because ultimately they're being paid out of funds that should be available, to either grow the company or to be paid to other shareholders.
Okay, Temidayo, maybe from the regulator side now, what's your perspective on that?
Okay, I think the first thing I'll say is that options are still open, so it's not been passed yet. The SEC is well represented on the committee looking at the finance bill. The major thing is weighing all options. I've been reading some of the comments around the finance bill. There are different sides of it, and like I said, just before joining this webinar, I just got back from a public hearing on behalf of the House of Representatives looking at a claim dividend. And there are so many considerations around it. The SEC has made its submissions. We are still around the round table looking at the most efficient way this can be dealt or should be dealt with. And there are various opportunities, and even for members of the public, different stakeholders, they've sent their positions, which currently the Minister of Finance and Budget and National Planning is looking at, and the SEC itself made a suggestion. There are other stakeholders around the table. But what I'll say generally is this. Unclaimed dividend has been an issue for quite a while. There are different things that have culminated into this pot of money. And I think I'll leave it on here that everybody has a part to play. It's just making sure that this pot of money gets shrunk, starting from proper identity management, giving your data to your brokers, even the registrars, making sure that there's real-time dissemination of this cash as soon as they come in, as they come into to effect. But the final end is this pot of cash, and the question is, how should it be dealt with, this pot of cash, when it comes finally fully unclaimed? Funchal made a point. It has been with the companies, so there is an incentive for the companies to even, to say, okay, we declare this money and it's come back to us. But the major thing is, you want, on the regulatory perspective, you want to make sure that people that have the rightful claim are given their own benefits of investment on time, and they actually have it. We have a view that having it started bad after 12 years in reverse to the company may be a disincentive to even mobilize all the effort in pushing this out. But what I say is our position has constantly been made lonely in terms of contribution to the finance bill. It's still being looked at. I'm sure it will, and as we progress, opportunities will be for, there will be opportunities for stakeholders to give their contribution in addition to what has already been given as well.
Well, I don't want to spend too much time on this, but I also have a very strong view on this. Partly just to illustrate that, yes, the money belongs to the company, but it's not their money. It's really the money of the shareholders. And sometimes they don't do enough diligence in tracing those shareholders. I give you an example without mentioning names. I have worked for about 3-4 banks in Nigeria here. But one of them, I saw my name in the list of unclaimed dividends. Now, nobody can say that they can't find me in Nigeria. I'm not bragging, but I think I'm a known person with my name there. And this is a bank that I worked for. So for that double reason, there's no, if somebody just checks this list properly. So between the companies and the registrars, I believe that there is not enough diligence that is used in tracking who that money belongs to. A second point I want to make is, yes, we are discussing capital market now, but there's another pool of funds on the money market side. A lot of money sitting in particularly savings accounts that for years the owners have died and the family doesn't know. I am sure if we total this amount on the money market side, it's far more than unclaimed dividends on the capital market side. So I think for balance, there is probably need for the government to also look at that side. Many of the banks are sitting on these kinds of funds for donkey years. The owners have died or they've changed address, they don't know where they are. And I'm sure when you see the figures, even as far back as when I was on the commercial banking side, the figures were really mind-boggling. But let's move forward. There was a point raised by Ian Bessarabia on the role of technology, and he wanted Haruna to answer that, and Haruna indicated that he will be ready to answer this during the Q&A. Haruna, I'm sure you are aware of the question asked by Ian. So maybe you should go ahead and answer it now.
Thank you, Dr. Usman. So the question is around that there are a lot of technology out there in the market. Let me just get that question. Okay, there's a lot of technology out there in the market and are changing how security servicing industries, operate or interact with their clients. And security services industries are people like us, post trade, who handle custodians, network managers, and all of that. And in terms of COVID-19, and he was asking, why is CSCS focused immediately? AI, APIs, or blockchain? So Ian, the truth of the matter is that we have done a proof of concept for blockchain, especially around America. And we did it in tandem with Standard Bank, Stanbic here, as well as a registrar, I can't remember, AP registrar. So we have done a proof of concept in terms of use of blockchain from a post-trade perspective, especially around announcements. Now, that is sitting somewhere in the sandbox, and the SEC has created a sandbox, and we have taken that thinking to the SEC, to the committee on technology. There's a technology committee which was submitted. We're like, look, we can't do it alone, we have to do it across market. That is an ongoing conversation. In terms of APIs, if you ask me, Ian, I know you used to work for Swift, because I know you. Swift is not integrated that much within our banking system in Nigeria, except they're talking outside. What I see in terms of what is working in Nigeria is APIs. Even from the CSCS perspective, what we've decided to do, so custodians, for example, we have APIs for them to connect to us to do a few things like transfer of, from one account to the other on behalf of a client, update client, open account. For the brokers, is an API to them as well to say, look, do what you want to do based on certain, protocols, as well as the registrars, which is a whole system we put in place that, sits in between us and them. If you ask me, APIs are the way to go. I know Swift is strong in terms of messaging across, but the way our market is created with the infrastructures like InterSwitch, and other switching companies, the way the banks are integrated is slightly different. Okay. Now, for the capital markets, the way we are connected to the stock exchange is different. The way we are connecting to the other exchanges is actually via APIs. So the question is, the big Swift, or should we do our APIs? The CSS is going the API way. We're not discounting Swift. We have Swift capabilities talking to our custodians. Now, in terms of, I think the first part, whether we're doing AI, of course. So we've just gone hyper-converged in terms of our infrastructure. So we're putting all the servers into one system, redundancy, backup, and all of that. And we're building a data lake rather than a data warehouse. So we'll throw in everything there. So we're building intelligence on top of that lake, such that, when we build the business intelligence, then the AI can come on top to do predictive analysis. But we're not there yet, but that's where we're going. And the APIs the data will be consumed, or rather the intelligence on data will be consumed by the market as a whole, following, the NDPR and GDPR laws across, so that we're not violating any of those issues. But certainly that's how we're working. And the APIs are the way to consume that data. And of course, we might probably create some income for ourselves doing that. I hope I've tried to address your question.
Thank you. Eric Idiahi. Faisal Bala says, currently most venture capital firms support Nigerian startups are foreign-based. Can Nigerian startups look forward to local alternatives? Private equity, the local banking industry, and so on. What's your perspective on that, Eric?
So it's a good observation in terms of the VC space. Startups or most to raise substantial amount of money have raised these funds from investors or VCs outside Nigeria. The Nigerian VC space, private equity space to some extent, is not really it's not as developed as the offshore space in VC. But we see that changing slowly. There are more entrants into the markets in Nigeria. You have to understand that in the VC world, it takes a certain kind of expertise to be able to value companies and invest in them, support them in that sense. But I think over the next couple of years, you're going to see more entrants into the Nigerian VC space. From this vantage, there's several conversations happening amongst different players and different VC companies trying to set up local VC funds in startups. So yes, the observation is correct, but in the near future, you're going to see a lot of changes with that. And also understand PFAs, insurance companies, and local asset managements are increasingly asking about the VC space, especially small successes like Paystack recently, and a few more announcements that will come in the next 2 quarters. So that will help spur up the local VC market.
Thank you. Alaji Babayo, Aminu Hamayo has raised the issue of subnational bonds being a great potential, particularly for the states, but that market is still very limited. What do you think can be done to actually improve the performance of that, particularly for the states and local governments to take advantage of that?
Well, actually, we still go back to regulation, transparency, even on the part of the state governments, how they want to take advantage of such bonds. In most cases, the states now, there is, what do I call it? There is a paucity of talented civil servants. They don't train their civil servants, so they cannot even really package projects that they can assess such things. The project packaging is very poor. Incidentally, I'm in Bauchi today. Yesterday, we held a meeting with the state government concerning them participating in the CPS, the contributory pension scheme. But the manpower, the state manpower now, I'm sorry to say, leaves much to be desired. So, and in most cases, the project they normally package are not really what we as PFA or private equities would like to participate in most cases. So I'm not saying, but there needs to be a little bit of advocacy, and much of advocacy and enlightenment to the state governments for them to even understand the opportunities that are there and the opportunities that are bound to them when they even key in to the contributory pension scheme. This gives them access to the capital market. So for now, I will say most of the states, the ability to package bankable projects and whatever is not there. Thank you, sir.
Do you want to add your perspective on this, particularly also not only state bonds, but other market products, options, futures, and so on, that will actually increase the depth of the market and the width, the breadth of it as well?
Thank you. Thank you very much for the opportunity, sir. So let me start by saying that I note and I do not dispute the capacity challenges that we have on the government side, even at the state levels. I do believe that states should learn to rely on professional advisors and consultants to help them to prepare, and ensure that their projects are well prepared and they're bankable. At Emerging Africa, and I'm sure at Stanbic IBTC with Funshaw and some of the other capital market operators here, we have been able to help and support issuers to be able to package and structure transactions that are acceptable to investors. Earlier, in the last 6 weeks, we structured a private bond for that was sponsored by one of the state governments, and it was grossly oversubscribed. And this is an instrument that will be FMDQ listed, and so investors feel comfortable that they can get out when they need to get out. So there are opportunities to support state governments, and we will continue to provide that support. With respect to the paucity of products in the market, I do agree that institutional investors remain concerned about macroeconomic issues that make the markets a bit risky, including volatility of interest rates, currency rates, instability, and other concerns. And these concerns emphasize that we need to have instruments like securities lending and swaps, and the full range of derivatives, futures, options that can hedge against, currency, for example, risk, interest rates risk, and so many other challenges that investors face. And if we have these instruments in the market, and I know that there are initiatives both at the Nigerian Stock Exchange and at the FMDQ that will put us in a better position in a short while. So as we have, a broader range of hedging instruments and products in the market, our market will become more attractive to institutional investors, both domestic and international. Thank you.
Dr. Graham Heffer, many people in Nigeria are critical of the government's privatization program. Your company was privatized many, many years ago, and I'm proud to say I was part of that. I was the Director General of TCPC when we privatized that company. It was a government company that was not doing well at all. We saw great potential. I'm very happy to see that your company is doing extremely well now, not only in terms of results, but in terms of performance on the capital market. It's certainly one of the best performing, and against all odds. It's in the agri sector. It was initially a government-owned company and so on. What do you think has accounted for the success of Okomo Oil Palm PLC, both in terms of performance and as well as the performance on the market itself?
Well, Dr. Usman, I think basically perseverance. That certainly is one of the key factors. Nothing else. The company has been going for about 43 years now, and as you said, rightly said, it started off as a federal government project in 1976. In 1990, there was the IPO for the company, and since then it's been public. And things have certainly not been easy. I can say that without fear. The problems that we do see is fundamentally, and I think everybody has the same problems. It's fundamentally lack of infrastructure, problems that we have with imports. If you're looking at funding, especially, for instance, shareholders now, we have myriad of shareholders who come from overseas, who are part of our shareholder base. They cannot get their dividends out right now. This is a problem that has caused our board to say, well, what do we do? Because if we wanted to expand, people are reticent in putting money in, because if they can't get the money out, why do we want to invest? So on the ground, that is a very important problem that we face. So we have to look at other means of identifying where we can get capital from. Thank goodness the central bank has come to our assistance largely. So we do look there, and that is at the moment our main source of funds. So going to the capital market is not an option, especially under the circumstances. If you want to take an overseas loan, again, you risk devaluations and those kind of things, which are certainly, again, a disincentive for anybody wanting to be involved in getting a shareholding in a company like ours. So in a nutshell, basically, it's not been an easy road, and I think there's a long road ahead still. The regulatory issues that we have, notwithstanding the fact that we have seen over the last couple of years, the regulatory bodies certainly starting to act better and to give us direction. there's still, in our opinion, a long way to go. You know, we don't advocate over regulation, which we tend to be seen now. And I don't know whether it's a knee-jerk reaction or it's something that is coming in, but we certainly want good governance, but not over governance, because that causes a lot of cost to us. And again, I must be honest, a number of shareholders have stated in the recent past that is it worthwhile still sitting on a stock exchange with all the costs that are associated with being a listed company. You know, these are areas of great concern. So yeah, it hasn't been easy at the risk of going on and on. I think at the end of the day, one has to just look forward and sometimes hope for the best and do what one has to do. I'm hoping that things will get easier in the future. We are going into hard times, and I think that notwithstanding the fact that the company has done very well, you know, we are a commodity-based company, and commodities can rise and fall pretty quickly, as we all know. And I'm hoping that that doesn't occur, and that we can carry on moving forward, notwithstanding the headwinds that we see that are coming towards us.
Thank you. I think we can go on and on and on, but we have to round up the webinar. We're already slightly over time. So I'll just close with, you know, our three panelists who have not spoken. The issue of infrastructure has come up so many times, so many questions I have here on infrastructure. So let us start with Deji. Any final thoughts on infrastructure? Then after that, we'll have Omohani, particularly on the issue of how can we have wider African cooperation, because that's important. We are having challenges with the common ECOWAS, even currency and other, they say now, if we're talking of Africa and with AFTA that has just been signed by Nigeria, maybe that there is a way forward. And then Hassan Usman will also say a little bit on, particularly from the point of view of ethical green finance. Not much has been said about green finance, even though Nigeria has great potential. The pollution in the Niger Delta, the Chad Basin drying up, there's a lot of potential, as was mentioned at the beginning, particularly for green finance. Deji, your parting thoughts?
Okay, thank you, Dr. Usman. I think for me, the issue of infrastructure is a big subject, because fundamental to all the problems we have in Nigeria today, and that's whether or not you believe in constitutional reform, is the issue of infrastructure deficit. And I think it's time for us in the private sector to have honest conversations about the quality of our relevance on the solution side. I think if I was in the public sector, I may not be as impressed as I could be with the role that the private sector has created or has played. And I think the reason for that is quite simple. We talked today about the creation of an 11 trillion naira industry. But in reality, even for those of us that were actively involved at inception, it was the benevolence of the public sector and not the ingenuity of the private sector that led to the creation of that industry. And I find that we spend too much time talking about risk. And it's not something we should downplay, because those risks exist and we need to protect investors or contributors' capital. The risk that we take with a sustained investment in fixed income that results in a return that does not protect the living standard in the future is just as great. And I think the reason we talk about risk when it comes to the role that the private sector can play in infrastructure delivery is because most of us don't pay attention to how concessions work. Concessions work on the basis of risk sharing. And oftentimes it's underpinned by government guarantee. So the same government that is borrowing almost 2/3 of the pension industry's capital and providing guarantee implicitly could be encouraged to look at how to create bankable deals that satisfies pension fund administrator so that they can deploy capital there. You know, the mistake that Nigeria is going to make if we're not careful is that through infrastructure, we're going to create solutions and create thousands of MTNs, and then we complain about dividend repatriation and all that. So I think the role that we as a private sector have to play is understand that public sector has limitation, have a discussion by taking a solution. These are the things that we need to finance your infrastructure. You're already guaranteeing bonds, so let's see how we can do it. So I think we have a role to play in the private sector, and it would be a shame if we think that the solution is going to come from somewhere else without us being a part of that solution. So I think the pension industry has a role to play, because this asset base, if that reform wasn't signed in 2004, then most of us will still be talking about an industry of just about 400 or 500 billion naira. So in the same way that the government has taken the lead in creating this opportunity that has rewarded the private sector, we need to go to the government and say, look, these are the solutions that we have. These are the things that we require from you. And this is how we want to draft concession agreements so that we can be a part of the solution to solving our infrastructure deficit. Thank you.
Thank you. Hassan, or Umahani, maybe you start and then Hassan will conclude.
Okay, so for me, I think, again, I have said before that we need more awareness. We need to make the state governments, the issuers, the corporates and the government be aware that these are opportunities for us to bridge the gap for infrastructure deficit we have in the country. And I feel that we should use PPs to go to these structures, and we should be able to say, okay, these are infrastructures, these are what are needed for us, and for the capital market operators to stand up and be involved. Because if everybody is sitting down waiting for the government, there has to be issues for the government to say, okay, go ahead, we'll be involved. I have seen that in the federal government's sukuk. Federal government came in, but then of course it's the market operators that led the federal government's sukuk. So I feel that the market, SEC had a 10-year master plan. I feel that it should be able to proceed and see it to its finality, and then we can have what we are asking the government to do, or what we have the infrastructure deficit to be able to bridge the gap. That's my thought.
Hassan?
Yeah, thank you, Doctor. I think the points have been made that this is an alternative finance that can provide significant amount of liquidity to address the infrastructure deficit in Nigeria. The three issues have shown that this is possible. And what is also interesting with Sukuk is that everybody will see what government has done with the money. It's unlike a bond that you take and you use for other revenue or expenditure, that salaries and what have you. This clearly everybody can see, and the level of transparency is much higher, and delivery of those projects are quite, assured. And this way improve relationship between the government and the government in terms of the utilization of resources. And it's also able to deliver on major infrastructures that is needed to push the development of this country, provide more employment, and the cycle of economic well-being savings is increasing, and therefore ability to even participate, because many of our people are excluded from the financial system, not by choice, but because they don't even have the resources, they don't even have the capability to be part of the system, because they don't earn enough to make them participants in the system. So infrastructure it is, and using Skook, especially in our environment, assured delivery, and therefore creates the enabling environment to do more and increase capacity of the nation to deliver on its long-term objectives.
Thank you very much. My apologies to our participants. We promised you 2 hours. We're already 15 minutes above. But for me, it's been a very exciting and really thought-provoking webinar, and I hope it has been for you as well. Clearly, the participation has been very active. We're sorry we couldn't answer all your questions, but we will try and send as many of them to our participants. And when they provide the answers, we have your emails. We will send them to you. Thank you very much also to our participants who have been with us for such a long time. This webinar was planned for 30th of October, and we had to postpone it. So thank you very much for being understanding. To our supporters and all participants, we thank you very much. I think this is a good point to bring the webinar to an end. I thank you all for your participation and attention. Thank you and goodbye.